welcome everybody to the latest episode of the Unlock Your Business podcast. Lucky today to have one of the financial planners, mortgage broker and partner at Manly Financial Services. And what we're going to talk about today is different ways to own property, different benefits in terms of buying in the property in different entities. We're also going to talk about wealth transfer, because what we do see in a lot of cases is scenarios where our clients, unfortunately, they'll pass, and then we've got to deal with inheritance and transfer.
Hi, you're listening to the Unlock Your Business podcast, where we discuss ways you can unlock your personal and business wealth with financial, investment and business strategies. I'm Rafi Pelagian. I'm a financial advisor and run financial services businesses that aim to help individuals, families and small to medium business executives manage, grow and protect their wealth. Through this podcast, I share my experience and knowledge from a financial advisor and business owner's perspective, in addition to my wins and struggles. So if you want an authentic and honest discussion on personal and business growth, investment, management, and unlocking wealth creation strategies, you have come to the right place. The Unlock Your Business podcast is brought to you by financial advice firm Manly Financial Services. Please see the website links in the show notes. We hope you enjoy the discussion.
Firstly, let me introduce Zareh. So Zareh is his partner, financial planner and broker at Manly Financial Services. So welcome to the podcast, Z. This is going to be a lot of fun, and hopefully this is going to be the first of many of these discussions, because we have a lot to talk about.
We do.
And they're going to become more comfortable and hopefully...
I'm 100% comfortable now, mate.
100%. Hopefully we'll start... It's a bit early in the day for a whiskey, but maybe if we do a later one, then if we can even crack open a beautiful bottle and talk through that as well. Yes. But let's maybe start with, I guess, your experience, your position, and how you sort of look at things from a planning and broking perspective.
Okay, so let's start off by saying I started planning first, became a broker second, and going off what you said with the different entities, I'm seeing a lot more of that.
Yeah.
Right? And I think I'm in a position of advantage because I have the planning background.
Yes.
So I've got more experience in at least setting up these loans as if the person wants to purchase a property in a family trust or a company. Look, at the end of the day, we want to do what's best for a client, and sometimes these entities help save thousands in tax for the beneficiaries, which hopefully one day will be our clients as well.
Definitely.
Yeah.
Isn't it interesting how, like, you look back when you started planning, and I started planning maybe 10 years before that. But I mean, we've done a lot of work together through that period where we've both sort of developed, and we've seen the firm develop and the clients develop. But isn't it interesting how we're now working on these more complex structures, whereas maybe back then, predominantly around the time of the GFC, it would
be individual stuff.
Yeah, all individual. But the investments felt like they were more complex.
Yeah.
And obviously a lot of those things fell apart.
I'd say the last 5 years.
Yeah.
Big change in the last 5 years.
Yeah.
And it's also, we're working closer with accountants.
Yeah.
Accountants always wanting customers.
And incomes are going up. We're seeing more clients who are earning, over $300,000-$400,000, and they need a lot of this.
And the partner might not work, or they want it for asset protection. You're seeing a lot more of it.
And the value add.
Yeah.
You know what I'm seeing a lot of is I'm starting to see more referrals from my clients of their kids, and their kids may be sort of my age, might be a bit older, but it feels like they come from a position where they don't really know what parents have done. And they don't really have a lot in their wheelhouse from an investment education point of view, and also they might have a super fund investment property, but they don't really understand some of the intricacies that their parents understand, even if their parents aren't really investment savvy style sophisticated people. What do you find around, I guess, education?
Look, I was going to say, firstly, it's an education piece, right? You got to make sure the beneficiary or the kids understand why it was put in the first place. A lot of the time, it's because of them. That's right. So they can save on the tax or save on the eventual inheritance.
Yeah.
So once they understand or they're comfortable with that, I guess, entity and structure, then you can talk about, okay, let's start planning for your kids and, you know. But I think education is a big thing because you don't want clients going into something that they don't understand.
Yeah,
and, you know.
Yeah, exactly. Yeah. And a lot of our clients have, you know, I'm not going to say complex structures, but a lot of them do have, you know, self-managed super funds, trusts, companies, whatever. And if the kids who, again, might be in their 40s and 50s don't understand it, then the chances of that wealth being maintained and continue to grow. So, you know, you see those families that have this multi-generational family wealth. I mean, that's really what we're trying to build, right?
Yeah. I've got a story for you for a client.
Yeah.
So this client unfortunately lost both parents within a year and a half, say, and they were quite well off.
Yeah.
Few investment properties, own occupied property. It was battle axe property. Had 2 properties.
Yeah.
And they were very comfortable with their accountant. It was based up in Queensland. And I actually wasn't the advisor of the spouse. I was the advisor of the husband.
Yep.
And then sort of it was just a natural progression. I ended up becoming the advisor for both of them. Anyway, long story short, they got the tax bill from so they sold their own occupied place, and there was 2 investment properties they sold.
So they inherited.
They inherited the
own
properties.
occupier and and then they went to sell.
And the unoccupied property had 2 dwellings on the block.
Yeah.
And they said, "Oh, can you just have a look through this?" And this, the example that I'm just saying here is more of a, you know, it's good to have an advisor just to, you know,
help
even
through.
if you're comfortable with the accountant, just to help through it. Second set of eyes, and it was like a bill for close to $350,000.
Wow.
And I said, hang on, something's not right here. And I saw that the accountant had put a capital gains tax on the own occupied property, the second property.
Okay.
Right? So I said, don't pay it. Just give me a week. Let me do my research. This doesn't sound right. What had happened was the parents had split the block, and they built a second property back in 2005. Right? But the land was purchased pre
85.
85.
Oh, so it's no CGT.
No CGT. So I said, well, I went back and I said to the client, I said, well, really, if you built a house in 2005, the dwelling doesn't appreciate. The dwelling depreciates.
Yeah.
The land depreciates.
Yeah.
So I reckon you should be paying 0 tax.
Yeah.
Sure enough, they went back from a $350,000 bill to 0.
Wow.
Yeah.
Saving 350 grand.
Yes, and that was just, and you know what? Really, the accountant should know more than me when it comes to. But it's just about.
And that's because it was owner occupier property.
Yeah.
Wow, that's crazy.
Yeah, and you know, they had investment properties. They had to pay tax. That's fine. And you know what? Maybe, you know, going off this topic, if there was property in trusts and companies, it might be a different story for these. Because they were all individually owned.
Yes.
By the parents.
Yeah, and that's interesting. We'll talk about this in a sec, but like I just saw some clients only today, and they had 4 properties owned individually, and I just, you know, and I get it. When you buy properties, maybe you don't think these things through, and it's not your first thought isn't a trust or a company or something like that, but it would have made it once you accumulate multiple.
Yeah, it makes a difference.
It does definitely make a difference.
You know what, Raf? Like you said, if you're going to be looking to buy a property, you're not thinking about 20, 30s down the track. You're looking about, okay, how can I get finance?
Yeah.
Now, I'll tell you right now, getting finance through a company or a trust is going to be a little bit more difficult than getting your personal name. That's just one example, right? Not every bank will lend to a trust or company. At the end of the day, if someone likes a property, they want to buy it. You know,
as soon as they can get the finance, they're off and away.
That's right. So that's just one example.
We can invest in a super fund, so we'll put that one aside for the time being. We might touch on it actually.
That's becoming very popular.
That's becoming very popular. So let's talk about personal investment, but let's talk about personal versus owning a property or an asset through a trust versus owning it in a company where the individual owns the shares in the company or the units in the trust. And then we'll talk about super fund because that's a different tax environment as well.
Okay.
But let's talk about some of the benefits. So obviously, let's talk about income. I mean, you buy a property. Well, actually, no, let's talk about from the start. We go and buy a property.
Yeah.
The main costs are we've got to come up with stamp duty. We've got to borrow the money.
And a deposit, say.
And a deposit, say.
Yeah.
So I guess it's more difficult within a company or a trust versus individually?
So off the bat, you're not going to get the choice. So not every lender will, right? But let's assume you do find one.
Yep.
They're just, I can't remember if it was St. George. One of the lenders actually are now against corporate trustees.
Oh wow! Okay.
As well.
Yeah.
99% of them are all done
corporate
trustees. You know, I think it's more so the choice because not every lender.
Is comfortable in that space.
That's right. Yeah.
And I guess they're going to assess. Let's look at trusts and companies. I mean, personal is easy. They look at my income and they assess serviceability.
It's the same thing.
Yeah.
If the entity or the company doesn't have any other assets, they will if there is. But if it's a brand new entity set up just for the purpose of buying that security, that property, they're going to take the members of the trust or the directors of the company as guarantors because they're going to use their income.
And serviceability. I guess, so that makes that easy. I guess you still pay stamp duty in all cases, right? Properties purchased, the income is flowing through, for the individual it flows through to their tax. So if it's jointly owned, they're both going to pay tax on 50% of that net income, obviously after expenses and interest. What about in a trust and a company?
Look, the big advantage of having a trust is you've got the discretion to offload or distribute the net income to whichever beneficiary you want. So that works really well with husband and wife, husbands on 400, wives on nothing. It makes sense to distribute the money. So that makes sense. Adult kids is a big one. We're seeing a lot more of that now. That's the main advantage. Besides asset protection and stuff, we're just talking about income.
Just talking about income at the moment. Exactly. And in a company, we don't really have to distribute that income.
You can keep it as retained earnings, and then pay out as dividends if you want. In the future.
100%. And the interesting thing is, from a tax perspective, if I'm a high income earner earning in the top marginal tax bracket, and let's assume that my average tax rate's around 40% or 45%, whatever it is, if I'm personal ownership, I'm paying tax at that amount. Via a trust, I'm paying tax on the net income at that amount. In a company, however, we're only taxed at the company tax rate.
30 or 25?
No, well, 27, unless
it's a trading company.
Unless it's a trading company. Exactly right. We've got some other consulting income or whatever it may be through that. So 27 is a hell of a lot better than 40 plus.
Absolutely it is.
And then you can, when you decide to take that income as in a form of a dividend, you can...
You just pay the top-up tax.
Again, you get that credit back. That's then we've talked about taxation. I guess it also, not only about tax, but you've got tax control with a trust, like you said, beneficiaries and a company. Let's talk about capital gains tax, because I think that's the main area where a company is the most disadvantaged. It's not a good. It's not as much of a benefit.
Well, you can hold it for 10 years, 6 months, 5 years. You're gonna get taxed at the same rate.
The same rate on 100% of the gain.
Obviously, personally, you get 50% discount. With a trust, it depends on the beneficiary.
But again, each beneficiary gets the distribution. And then they all each get their discount.
The discount.
So it works out really well. So
if they're in a higher tax bracket, let's say, you can still use a bucket. I don't know. We didn't mention before. With a trust, you can have a bucket company and have all the benefits of a company tax rate.
Yes.
With the company being the beneficiary.
Yeah. Isn't that crazy? I mean, there's so much. There's so much we can do now. It's actually quite exciting times.
Until the government changes.
Until the government changes the rules, and then we'll find other ways to get the same benefit for our clients. And I guess we talked about, so that's the biggest disadvantage of a company, in that we don't have that 50% discount. In saying that, a high income earner earning the top marginal tax rate at 47 or 45, 47.
Probably, yeah.
Yeah. Anyway, the highest marginal tax rate, they're still going to be paying a bit more, even if they pay on 100% of the gain through a company.
Yeah.
At 27%. But there are ways to sort of manage that, super contributions, whatever it may be. So then we get to the point where, let's say that we've bought the property, we've managed our tax as well as possible. Well, let's talk about asset protection. I think that's important to touch on, even though we want to talk more about transfer of assets through estates and this, that, and the other.
Yeah.
Company trust, a hell of a lot better, right?
Yeah. Yeah. Touch wood, I haven't come across anything like that with my clients, but I have heard horror stories of people being sued and stuff, and at least in a with a major asset like a property being protected in a family trust. It's a lot more comfortable for the client knowing that
that's right.
Almost untouchable.
Yeah. And I think that's where the importance of the company structure comes in terms of how you set it up. So you said before that if it's a trading company, then it gets taxed lower, right?
Yeah.
And that's obviously something that we like. Obviously, lower tax is what you prefer. But the scenario is that if the trading activity is one where the client may have risk of being sued or this, that, and the other, then you really should be careful about doing that and maybe having those operations
pay
separate.
The extra tax.
Pay the extra 2%.
Yeah, and use a different entity.
100%. Have you seen the scenarios where you have multiple beneficiaries, property, and we want to sell? Some of the mess that can occur.
I have.
Yeah.
I have multiple times. Only one of them was messy.
Yeah.
But all the other ones, at least the beneficiaries were all on the same page and stuff. But I did. There was one instance where it was quite messy. One of the beneficiaries wanted it sold straight away.
Yeah.
The others wanted to fix it up. They thought they'd add value. Yeah, gets quite messy.
Yeah, it does. It does. Everyone does have to be on the same page.
You know, if this conversation's taught me anything, man, the value of advice.
Yeah.
is priceless almost.
Yeah, it is.
And a simple thing, right? It's sort of got to do with this. A client emailed me the other day. I want to update my beneficiary forms.
Yeah.
For a standard super fund.
Yeah.
Okay. I want to nominate my boys. I said, okay, that's fine. How old are your boys? They're adults. And I just, it was a simple line. The tax is different to.
Yeah.
It took me 2 seconds, but that's probably saved so much for the client. Yeah. I know it's not part of this thing, but it's...
No, but you're 100% correct.
It's crazy. Correct. And then just going for this, we could go on for hours and hours.
Yeah.
A lot of stuff that our clients... Well, it's our job to educate the clients, right?
That's right. It is, but at the same time, it's about opportunity to do that. And unfortunately, there's so much noise in our industry, whether it's about compliance, whether it's around what's happening in the markets. I mean, at the moment, all we're talking about is US election that's coming up in November. We're talking about interest rates. All that noise stops you from talking about the important things. And realistically, market volatility is just a blip. And unless it's something like a GFC, we're going to forget about it in no time. I mean, it's the GFC is the last one I really remember. And prior to that was, say, .com.
Yeah, but there was a big dip during COVID as well.
But we forgot that because it was such a quick, short, sharp, V-shaped recovery.
You're not investing for 2 years, you're investing for 30, 40 years.
Yeah, but this is the point, right? When we're talking about transferring assets at a time of inheritance, time of death, you talked about that scenario where you've got a family where not all the beneficiaries are on the same page. With all the noise and everything that happens out there in everyone's life, whether the clients and advisors, whatever, it's really important, and we're seeing it more and more, just to be able to stop. And this is why we've developed this family financial planning and intergenerational wealth transfer sort of program to educate clients in their own time around, hey, we need to sit down and plan this. We need to sit down, and even if we don't do it as around the big table with all the beneficiaries and the parents, even if we do it individually, let's get everyone on the same page. Let's give everyone the same level of education so they're on the same page.
That will add so much more value than...
Let's facilitate, I want to keep it, I want to sell it, that kind of... Let's facilitate those discussions and then work to be able to come up with a solution that works for everyone. I think that's, I think that's definitely something that should happen. I mean, we talk about clients who pass away or who are on their deathbed. I know it's a morbid topic, but with superannuation and how important it is for people to call us, so we can save them that tax you're talking about to the adult children, the 17%.
That's right.
That sort of planning has to happen before, before the untimely death event. No, that's key. I tend to agree with you, Zareh. I think it's really important that, we're hoping to do that with our clients to try to get in front of them earlier on, just to plant the seed to say, hey, we've got to talk about these things. It's not just a will, power of attorney, and testamentary trust.
You know what the key is? It's not just about implementing it. You really want them to understand.
Understand.
Because, I mean, sometimes the client will come in and get everything done, and then they'll walk and they'll live their life, and I don't know, like, appreciate's the wrong word. It's more like maybe they don't see the true value that was added. Maybe then,
and maybe they see it today, but they don't see what we've got to do in 10, 15 years.
That's the point I'm trying to make.
I think the notion of a family financial plan, not in terms of the traditional statement of advice that we give, that is really stupid and written for compliance people and doesn't really make a whole lot of sense.
80 out of 100 pages is useless.
Ridiculous, exactly. But more so maybe a presentation or some sort of thing to say, okay, kid A and their partner want this, and kid B want that, and kid C. Because I mean, you have a kid if you've got a child who's got an intellectual disability, and you've got a super fund, well, they can benefit from the tax implication of the super fund. One, it'll be tax-free pension, right? Doesn't matter what age they are. But two, it's in a separate vehicle, so they're not going to be taken advantage of. The asset's protected. The income that's going to come to them is protected. There's that longevity, Whereas you might have
the other children will be treated differently.
100%. 100%. So you can sort of equalise the estate without going, 50-50 or 30-30, 33% on everything type of thing if there's 3 kids or whatever it is. So let's finish up, I guess, by talking about what you're seeing in the finance market, banks, rates, what type of offers they've got, who are they more willing to lend to, what's easy, what's hard.
Let's start off by saying the market's slowed down, definitely. I'm still getting inquiries come through, but just it's not as busy as it was last year, the level of transactions, and also banks say when it's busy, they'll have turnaround times of up to a week, whereas now most of the banks, they'll pick up a file within a day or two, so that says that they're not getting a lot of volume. With interest rates, you'd be very lucky to get anything under 6%. There are some banks still offering that, but the majority of them are low 6s, and then investment you're looking mid 6s. Borrowing capacity is still an issue. Because property prices have still been creeping up. People's wages haven't, and they want to get into their desired area. And borrow. A lot of them are clients coming.
Well, you think that's going to have an effect on property prices at some point?
At some point,
You'd think so.
I feel as though a lot of the time the clients are like, what's the max I can borrow?
Yeah.
Because they want to go into a particular area, and and we can help with that because every bank has got a different borrowing capacity.
Yeah.
You know, CBA compared to First Mac is a massive difference in borrowing capacity.
And it changes, right? Because based on their appetite at the time to borrow or you know.
Yeah, it changes. But say the top 5 lenders with borrowing capacity always usually in the top 5.
Okay.
But that it varies, and it varies because they'll have different calculations on what their living expenses would be for say an average family of 2 kids, and their assessment rate might be different. So for the people out there that don't know, if you're going to get a loan with a rate of 6.5% for argument's sake, the bank will put a buffer of say 2 to 3% on top of that 6.5%. So unless you can prove with your income that you can afford a 9.5% rate, your loan won't be approved.
Yeah.
Okay. They had I don't know if it was 2 years ago. Yeah, probably 2 years ago. They brought in this 1% buffer rule for people with fixed rates that were expiring, and they wanted to refinance them.
Okay.
And they said, okay, for those clients that have a clean credit history, no missed repayments, we're willing to take you on. Okay.
Yeah.
And they'll calculate you on a 1% buffer
over and above the variable rate.
over the year. So, and that was a big difference in borrowing capacity.
Yeah.
Massive difference.
But that's important because if not, you've potentially got a property market collapse. Right. If all the people off fixed rates could not get their loans.
Yeah. Well, you're right. But the thing is, it wasn't like they were going back to 2%. It just meant that it was almost like a band-aid fix because the clients, say the clients in a loan, say they're 7 years into a term or 8 years into a term, their fixed rate's expiring, their fixed rate is 2% expiring. I'm going to give them a rate of say 6%.
Yep.
But affordability is an issue, so I'm resetting the term back to 30 years.
Yes. Yeah.
So it's all like a band-aid fix.
Yeah.
But at the end of the day, we want to help the client.
That's right. That's right.
You know,
and that's the beauty of I think having the broking business within a financial planning firm. And I mean, you're both, right?
Yeah.
You wear both hats, but we've got other brokers in here that aren't planners and planners that aren't brokers working collectively together, because I feel that you're right, like you said earlier. If I want to buy a property, I'm a client, I want to buy a property, okay, rate's important to me, but if I'm if it's not that easy for me to get the finance, then I'm going to take whatever I'm given, right?
Yeah.
But at least from our perspective, we can come at it from a financial planning lens as well, look at their cash flow, look at the budgets, look at structuring, all that kind of
entities, like we said before, all that stuff's important.
Yeah.
Absolutely. And on top of that, you get a loan. What's important as well?
Yeah.
Protecting your wealth. So what comes after getting a loan? Getting the insurance done as well.
Yeah.
It all ties in really nicely.
Definitely.
Yeah.
No, definitely. No, I think these are really important things for people to think about. Unfortunately, as I said, once you've got your loan or whatever it is, it's not addressed. That estate planning, all that kind of thing is not addressed as much as it really should be. I just want to wrap up there. This is going to be the first of many discussions I have with Z. We've got one that we're planning around superannuation. Obviously, it's quite topical. Self-managed super funds.
Maybe we'll do that one with cigars and whiskey.
Yeah, that should be with cigars and whiskey on a relaxed sort of afternoon, and we should talk in that one around also going the next step around talking about when it's appropriate and when it's not appropriate to be buying a property within your super. Not that we're against it. We're not against it in any way, shape or form, but I think sources for courses, right?
A lot of people come to me with $50,000, $60,000 balances. I go, oh, hang on.
Exactly.
What are you going to achieve?
Yeah.
With? Yeah.
But anyway, that's a discussion for another day. Yeah. I think our brains will be fried if we start on that one, and we will never end. So thank you very much for listening and watching.
As always, this is not to be taken as advice and is definitely general in nature. I hope this discussion has been beneficial. If you've watched this on YouTube, please leave a thumbs up, subscribe, and leave a comment. If you're getting the non-YouTube version of this podcast from wherever you digest your podcast content, then please comment, like, and follow. Thank you. We really appreciate that. Lastly, this episode is brought to you by financial advisory firm Manly Financial Services. We focus on providing specialist financial advice to individuals and now working more and more with small to medium business owners and executives in that space. Please visit our website, manlyfs.com.au. Hope this discussion and information has been of benefit and engaging. If you'd like some more help, please reach out, go on our website to connect. We'd be more than happy to have a discussion and to help where we can. Take care, and we'll see you in the next one.